Lundin Gold Inc. (LUG) represents a distinct investment profile within the senior gold mining sector, driven almost entirely by the performance of its 100% owned Fruta del Norte (FDN) mine in southeast Ecuador. The primary investment thesis is founded on the mine's world-class operational economics, which deliver industry-leading margins and generate exceptional, reliable free cash flow (FCF). The FDN asset is among the highest-grade operating gold mines globally, translating operational superiority directly into financial strength. The company demonstrated this strength conclusively in its 2024 results, achieving a record annual gold production of 502,029 ounces. This strong performance continued into 2025, culminating in record net income of $208 million and robust free cash flow of $191 million in the third quarter alone. Critically, Lundin Gold has leveraged this profitability to attain a debt-free balance sheet and fund a highly aggressive capital return program to shareholders. Despite this foundational operational quality, the investment carries a commensurate geopolitical risk premium. The core challenge resides in the single asset concentration. FDN accounts for nearly all of the company's revenue, and the complex, often unstable, operating environment of Ecuador. Furthermore, the Ecuadorian fiscal structure, particularly the 70% extraordinary revenue tax, acts as a structural cap on the maximum margin expansion the company can achieve during periods of supernormal gold price appreciation. The market currently reflects the high quality of the asset, assigning LUG a significant valuation premium compared to many peers. Consensus earnings estimates suggest a forward price-to-earnings ratio of approximately 26.23 times for 2025, which is projected to compress moderately to 21.54 times by 2027 as cash flow stabilizes. This premium implies that investors are willing to heavily discount the geopolitical risk in exchange for guaranteed low-cost production and high cash returns. The most crucial factor for sustaining this valuation is the successful execution of the aggressive exploration and conversion drilling program, which is scheduled to deliver an updated reserve estimate in early 2026, fundamentally de-risking the mine's longevity. 2. Macroeconomic environment and gold price tailwinds. Lundin Gold's superlative financial results in 2025 were substantially bolstered by a profound structural shift in the global gold price regime. By late 2025, gold prices had broken through critical resistance levels, exceeding $4,000 per ounce in October and briefly pushing beyond $4,200. This sustained rally reflects more than transient inflation concerns or short-term monetary policy expectations. It signals a deep global shift driven by persistent geopolitical instability, the use of sanctions as a policy tool, and mounting doubts regarding long-term monetary stability. A distinctive driver of the current gold market is the unprecedented demand from the official sector. Central bank buying has provided a powerful structural floor for the price, doubling its historical average since 2022 and rising to nearly 25% of total global demand in 2024. This demand, coupled with investor flows capitalizing on macro and political fear, has amplified the upward trajectory, projecting further price gains into 2026. The strong macro environment translates directly into LUG's earnings power. During the third quarter of 2025, the company achieved an average realized gold price of $3,634 per ounce. This elevated price environment ensures that LUG maintains an exceptionally high margin over its low all-in sustaining costs. However, the high realized gold price introduces a structural limitation imposed by the Ecuadorian fiscal structure. Under the exploitation agreement, the government assesses an extraordinary revenue tax, or windfall tax, at a rate of 70% on net smelter revenue that exceeds a specified base price. This base price is dynamically determined as the trailing 10-year average daily price, escalated by the U.S. Consumer Price Index, plus one standard deviation. Since the gold price has moved into a new, structurally higher regime, LUG's quarterly realized price perpetually exceeds this threshold. Consequently, while the company benefits substantially from higher revenues, the 70% tax rate means LUG captures less margin elasticity from supernormal price spikes than peer miners operating in stable, lower royalty jurisdictions. The counterpoint to this fiscal drag is the fundamental quality of the FDN asset. Its superior, low underlying cost structure offers a strong buffer against price volatility, ensuring profitability even if prices moderate significantly. 3. Corporate profile, strategy, and disciplined capital allocation. Lundin Gold operates with the strategic backing and institutional expertise of the broader Lundin family of companies, which has a long track record of developing large-scale, world-class mineral deposits, often in challenging emerging markets. Management and strategic focus. The company's executive leadership is structured to prioritize disciplined growth and strategic financial management. The team, led by President and CEO Jamie Beck, includes key individuals like Chester See, CFO, who brings experience managing finance through major corporate transactions, and Brendan Creaney, Vice President Corporate Development and Investor Relations, who has substantial project finance and corporate development experience from senior gold producers like Goldcorp and Barrick. This blend of operational and transactional expertise suggests a strong organizational mandate focused on maximizing asset value and potential strategic opportunities. Strategic de-risking and financial strength. A cornerstone of the company's strategy was the fundamental restructuring of its balance sheet in 2024. On June 27, 2024, Lundin Gold completed the buyout of its remaining stream facility and offtake for $330 million. This action achieved immediate financial de-risking by rendering the company debt-free. By eliminating the stream, the company captured 100% of the FDN cash flow upside for its equity holders, simplifying the capital structure and enhancing financial resilience in a volatile operating environment. This strong financial position continued through 2025, with a cash balance of $494 million reported as of September 30, 2025. The large cash reserves and debt-free status serve as a crucial structural mitigation against the inherent sovereign and financial risks associated with operating in Ecuador. This liquidity ensures the company can fund all planned capital expenditures, community obligations, and operations without needing to access potentially restrictive or unavailable international capital markets, thereby enhancing its operational autonomy. Capital allocation and shareholder returns. LUG's capital allocation strategy is highly focused on returning capital to shareholders while simultaneously funding internal growth. The dividend policy was proactively amended in 2024 to increase the fixed quarterly cash dividend and incorporate a variable component tied directly to normalized free cash flow. The commitment to this policy was clearly demonstrated in the third quarter of 2025 when the company declared a substantial dividend of $0.80 per share, comprised of fixed and variable components, reflecting a variable payout ratio that utilized 100% of normalized free cash flow. This commitment distinguishes LUG as a high-yield vehicle within the gold mining space. The combination of a clean balance sheet, substantial cash flow, and a management team with M&A experience suggests that the company is strategically positioning itself to leverage its financial strength once the long-term mine life of FDN is further secured by the impending 2026 reserve update. The company may utilize its strong capital position to pursue strategic acquisitions or partnerships, accelerating its diversification mandate. 4. Operational Deep Dive Fruta del Norte's World-Class Economics. Fruta del Norte, FDN, is the singular engine of value creation for Lundin Gold, consistently delivering exceptional operational performance defined by high grades and low costs. Production and throughput profile. FDN achieved record annual gold production of 502,029 ounces in 2024, processing 1,690,085 tons of ore. The operational advantage stems from the mine's grade profile. The average grade of ore milled in 2024 was 10.5 grams per ton. For 2025, the company elevated the lower end of its production guidance to a range of 490,000 to 525,000 ounces. This output is supported by projected mill throughput of 5,000 tons per day in 2025, which is slated to increase to 5,500 tons in both 2026 and 2027.
Projected head grade for 2025 is 9.2 grams per ton.
Industry-leading cost structure. The high head grade and efficient underground operation yield a profoundly competitive cost structure. The full-year all-in sustaining cost AISC for 2025 is projected to range between $935 and $995 per ounce sold. Looking forward, the company anticipates further minor cost improvements, guiding AISC to a range of $925 to $955 per ounce by 2027. This cost efficiency positions LUG favorably against global peers, ensuring wide profit margins even if the realized gold price were to retreat significantly from current highs. For the third quarter of 2025, LUG reported a cash operating cost of $861 per ounce and an AISC of $1,036 per ounce sold. While this Q3 2025 AISC figure was above the full-year guidance midpoint, analysis of the financial results reveals a crucial dynamic related to the local fiscal structure. The reported cost metrics were negatively impacted by the record-high average realized gold price, $3,634 per ounce. Under the Ecuadorian regime, royalties and statutory profit sharing payable to employees increase directly with realized gold prices, and these payments are incorporated into the calculation of both cash operating costs and AISC. Therefore, the reported AISC reflects not just operational efficiency, but also a substantial, revenue-driven fiscal element that scales with profitability. Operational reliability and capital management. The company maintains predictable sustaining capital requirements necessary to maintain production, with annual guidance ranging from $70 million to $90 million through 2027. This capital is deployed for critical infrastructure, including the ongoing construction of the fifth raise of the tailings dam, expected to be completed in the first quarter of 2026. Recognizing external vulnerabilities, LUG proactively invested in operational redundancy. Following the electricity crisis that negatively impacted Ecuadorian exports in 2024, the company commissioned 4 additional diesel-powered generators during the second quarter of 2025. These generators are now operational and are expected to allow the FDN process plant to run at or near capacity even in the event of a total power disruption from the national grid, significantly enhancing operational continuity and mitigating a crucial jurisdictional risk. 5. Reserves, resources, and mine life extension catalysts. Lundin Gold's primary strategic priority is to address the single asset concentration risk by aggressively extending the lifespan of FDN. The current investment thesis relies heavily on the success of the ongoing resource conversion program, current reserve base, and longevity. The current mine plan is built upon a substantial foundation of 5.50 million ounces of gold in proven and probable reserves, derived from 21.70 million tons at an average grade of 7.89 grams per ton. As of the end of 2024, this reserve base underpinned a robust mine life of 12 years. Aggressive exploration and conversion strategy. The company is committing significant capital to exploration, budgeting $32 million for near-mine activities in 2025. The most critical element of the growth strategy is the accelerated conversion drilling program focused on the southern portions of the Fruta del Norte deposit, FDN. In 2025, Lundin Gold expanded the conversion drilling program from an initial target of 15,000 meters to 25,000 meters, representing the largest drilling effort undertaken in the asset's history. This intensified effort aims to move significant inferred resources into the higher confidence measured and indicated categories and ultimately into proven and probable reserves. The exploration success has been encouraging. The FDNS zone, located along the southern limit of the main ore body, has already been identified to host a sizable inferred resource of 2.09 million ounces, grading 5.25 grams per ton. Recent drilling at FDNS and FDN East confirmed mineralization continuity and indicated higher grade zones. The 2026 Reserve Catalyst. The culmination of this massive drilling program is the anticipated publication of an initial reserve estimate for the expanded areas in early 2026.
Successful conversion of a material portion of the 2.09 million inferred ounces would transform the perception of the FDN asset. While the inferred grade of the FDNS resource, 5.25 grams per ton, is lower than the current average milled grade, 9.2 grams per ton, the inclusion of these ounces in the reserve base would be highly accretive. This is because extending the life of such a highly profitable low-cost asset by several years yields a substantial increase in its net present value, NPV, fundamentally de-risking the core investment thesis against the risk of rapid depletion. For investors, this resource expansion is the single most important near-term catalyst. 6. Jurisdictional and geopolitical risk assessment. Despite the world-class status of the FDN deposit, the stock's valuation multiple is structurally constrained by the inherent jurisdictional risks of operating exclusively in Ecuador. These risks are multifaceted, encompassing political, regulatory, social, and security dimensions. Political and security instability. Ecuador, while possessing mineral resources on par with neighboring mining giants like Peru and Chile, is afflicted by chronic socio-political instability and security challenges, including a significant illegal mining problem. The Noboa administration has promised a new strategic mining plan by the end of 2025, but the overall investment climate remains uncertain. Any severe or prolonged national political crisis, community unrest, or deterioration in security could severely disrupt operations at FDN, demonstrating the acute vulnerability associated with the company's single asset concentration. Regulatory and fiscal constraints. The regulatory environment imposes a restrictive fiscal regime. The exploitation agreement mandates a royalty of 5% of net smelter revenues. More significantly, the structure includes the extraordinary revenue tax or windfall tax, which taxes 70% of the difference between net smelter revenue and a dynamically escalating base price. As confirmed by the Q3 25 results, record-high gold prices ensure the continual activation of this tax, leading to higher accruing royalties and profit sharing payable to the state and employees. This design limits the financial upside LUG can capture during periods of extreme commodity price strength, resulting in a substantial amount of economic rent being transferred to the state. Mitigation through liquidity. The company has strategically mitigated financial exposure to this volatile operating environment by ensuring maximum liquidity and a clean balance sheet. The decision to retire all debt in 2024 and maintain a substantial cash balance, approximately $494 million as of September 30, 2025, provides an unparalleled financial buffer. This liquidity guarantees LUG's ability to manage operational setbacks, fund required capital upgrades, such as the power generators, and continue its commitments to community development without dependence on external financing that could be constrained during periods of national instability. This approach provides a level of operational resilience difficult to match by more leveraged peers operating in high-risk jurisdictions. Social contribution and community trust. The company actively builds consensus and trust within its area of influence through substantial community investment. Direct economic contributions in Ecuador totaled $290 million in 2024. Social initiatives include strong support for local suppliers, with $28 million expended in the Zamora-Chinchipe region, and co-financing large-scale urban regeneration infrastructure projects with local government. The achievement of zero significant safety incidents on site and the extension of essential services such as internet connectivity to all 22 local communities further solidify its social standing. This proactive investment in its social license directly addresses key risk factors, such as community relations and potential regulatory obstacles, which are commonly cited as threats to mining operations in Ecuador. By demonstrating transparency and adhering to international best practices, LUG creates a protective barrier against localized unrest and regulatory intervention.
Investment conclusion and key drivers. Lundin Gold offers a compelling investment case for sophisticated investors seeking exposure to one of the highest quality, lowest cost gold assets in the world. The company's financial profile is pristine, defined by high FCF generation, a debt-free balance sheet, and a transparent commitment to aggressive capital returns via a variable dividend policy. The operational quality of FDN, characterized by high grades and an AISC expected to remain below $1,000 per ounce through 2027, is unmatched by many senior producers. The fundamental assessment confirms that the current premium valuation is largely attributable to this operational superiority and the company's strategic de-risking actions, debt elimination, power redundancy. Key investment drivers. Future performance and the justification for the sustained valuation premium hinge on three principal factors. Reserve extension success. The successful outcome of the expanded 25,000-meter drilling program and the subsequent publication of the new reserve estimate in early 2026 is the single most important internal driver. Conversion of significant inferred resources will materially extend FDN's life beyond the current 12 years, effectively mitigating the structural risk of single asset concentration and increasing the asset's long-term intrinsic value. Gold price stability. While the current macro environment is highly favorable, LUG's exposure to extreme price rallies is curtailed by the 70% windfall tax. Sustained gold prices in the current regime are necessary to justify the high PE multiple, but the low-cost structure provides excellent downside protection against moderate price moderation. Ecuadorian stability. Despite strong localized risk mitigation strategies, including operational redundancy and high community investment, LUG remains fundamentally exposed to systemic political and security crises in Ecuador. Any significant national event could halt operations and severely impair cash flow, underscoring the necessity of closely monitoring the country's socio-political trajectory. In conclusion, Lundin Gold is structured for resilience and shareholder reward, but it remains a complex jurisdictional play. It is best suited for investors who prioritize high, reliable free cash flow and dividend yield derived from a world-class deposit, while accepting the inherent volatility and fiscal constraints imposed by a high-risk operating jurisdiction.